Many candidates have struggled with the proper treatment of events that occur after the reporting period. That is, many candidates incorrectly classify an event as adjusting or as non-adjusting, which in turn would affect the presentation of the current period financial statements. In this knowledge clip, we will look at the general principles of IAS 10, as well as the practical examples. After completing this, you should be able to correctly classify an event as adjusting or as non-adjusting, as well as correctly determine the appropriate treatment relating to each. The first phase for dealing with events after reporting period is to decide if they are adjusting or non-adjusting. The second phase would be to determine the appropriate accounting treatment. We will address each phase later on. If we arrive at the incorrect conclusion for phase 1, that is, if we incorrectly conclude that an event is adjusting or non-adjusting, then the appropriate accounting treatment, which is phase 2, would ultimately be incorrect. So it is important to arrive at the correct conclusion for phase 1. Let's begin with a general rule using a decision tree. An event after the reporting period is adjusting if it relates to or provides additional evidence of conditions that existed at the end of the reporting period. The exact opposite applies to a non-adjusting event. That is, an event that relates to or provides additional evidence of conditions that did not exist at the end of the reporting period would be considered a non-adjusting event. Applying the general rule can get complicated with a number of factors that would need to be identified and taken into account. Thus, the best technique when applying the general rule is to use a timeline. This would enable you to visualize information and will be invaluable in aiding you to arrive at the right conclusion for phase 1. That is the event adjusting or non-adjusting? So if we use the timeline, the first step would be to plot the financial year end. The second step would be to appropriately plot the events and related information on the timeline. If the event relates to conditions that existed prior to year end, then it is an adjusting event. If it relates to conditions that existed after the financial year end, then it is non-adjusting. Assume a company, ABC Pharmaceuticals, has a financial year end on 30th June 2014. ABC recorded inventory which includes drug X valued at $300 a box. The records show that ABC Limited has 500 boxes. On the 15th of July, the auditors discussed the results of their inventory count with ABC management and indicated that there were only 430 boxes of drug X. The auditors are of the opinion that the other 70 boxes may have been stolen due to recent increase in demand for drug X. On the 31st of July, the government introduced new regulations that place a ceiling on the price of drug X. The price of drug X would be capped at a maximum of $250 a box. Using the timeline technique, as well as the decision tree, consider if the events are adjusting or non-adjusting. We can now analyze the information relating to each event and using the decision tree, consider if it provides additional information about drug X as at the period end or not. The auditor's discussion with ABC management relate to their inventory count, which was performed at the financial year end. Therefore, while the actual discussion with management took place after year end, it still relates to the valuation of drug X at the period end. That is, the financial statements indicate that there was 500 boxes of drug X on 30th June 2014, when there was in fact only 430 boxes of drug X on 30th June 2014. Therefore, this is an adjusting event. Once we conclude that an event is adjusting or non-adjusting, which is phase 1, we need to decide on the appropriate accounting treatment for it. This is phase 2. If an event is an adjusting event, then in phase 2, you would simply be required to process an adjusting journal entry to account for the transactional event as if it occurred prior to year end. This means that both the statement of financial position and the statement of profit and loss and comprehensive income may need to be adjusted. So if we go back to the example on ABC Pharmaceuticals, we have already concluded that in phase 1, the auditor's discussion with management relating to the inventory count is an adjusting event. In phase 2, we would process the following journals: debit inventory write-off expense for $21,000 and credit inventory for $21,000. This is because we know that 70 boxes of drug X were missing at the financial year end. Each box is valued at $300. So the inventory write-off is calculated by multiplying the number of missing boxes with the value of each box. If the event is a non-adjusting event, then you are required to further evaluate the significance to users and other stakeholders. That is, you are required to evaluate if the event is material or not. If it is likely to affect users' decision-making, then it is considered material and is required to be disclosed. If it is not likely to affect users' decision-making, then it is not considered material and does not require disclosure. New regulations that place a price ceiling came into effect on 31st of July 2014. This means that going forward, ABC Limited would not be able to sell drug X for more than $250. This event relates to the way drug X will be measured in the next financial period. Thus, this is a non-adjusting event. Assume that investors base their buying decisions on the performance of drug X. This new regulation would then affect their buying decision, and thus, accordingly, it would require disclosure in the financial statements. The notes to the financial statements would need to explain the nature of this event and would also need to include an estimate of the financial effect.